Welcome to this week's episode of Accredited Investor Markets Radio. Each week, we speak with you about investing in alternative assets. Unbiased and beholden to no one, Accredited Investor Markets Radio does not accept advertising from any investment firm or financial advisor. Accredited Investor Markets Radio is the spoken word sister of AccreditedInvestorMarkets.com, the internet's most comprehensive and unbiased educational resource about crowdfunding, angel investing, venture capital, private equity, private shares, and other investment classes beyond publicly traded stocks and bonds.
Hello, everyone, and welcome to Accredited Investor Markets Radio. I am the host, Christopher Cahill. Later on, we'll be talking with David Drake about global trends in angel investor networks. But first, a few words about innovation, startups getting bigger, and the context for these things. This story starts with a Wall Street Journal article called Ports Get Creative as Cargo Piles Up, dated March 1, 2015, written by Erica Phillips. It tells the story of the end of the West Coast dock strike and the innovation that occurred during the dock strike, which portends more efficient port operations in the future. So first, there was a West Coast dock strike, and it was a huge event. It disrupted logistics nationwide. And by the way, logistics were something we talked about at length with Kai Trepta a few weeks ago. Anyway, the Southern California ports themselves combined to handle 40% of all containerized freight for the U.S., and this dock strike covered the entire West Coast. Now that it's been resolved, this dock strike still will affect the timing of delivery for 6 months or more. But necessity is the mother of invention, and terminal managers were forced to scramble to try to get what efficiency they could from what unloading of ships and loading of trucks was occurring. A company called Cargomatic offered to help. Well, what does Cargomatic do? Cargomatic helps the unloading of ships and the loading of trucks process. But first, if you are a large retailer and you have a huge number of containers on one ship coming into port, getting them onto trucks efficiently is pretty easy. You just line up a bunch of your trucks or trucks that are contracted to you, and the unloaders of the ship put the containers from Walmart or Target all in one place. Each truck just gets a container and goes on its merry way. They are all Walmart trucks, or they are all Target trucks. This is called the free flow or peel-off operation in a port. But many, if not most, retailers are smaller, and they do not have the ability to fill up an entire ocean-going container ship with their containers. So how do you get the container out of the ship and into that particular truck? Well, that's called digging it out, because the ship gets unloaded, it's all over the dock, and somehow, eventually, that container gets put on the truck, and this means the truck waits there a long time. Cargomatic offered to solve this problem with regard to the smaller retailers, basically through an Uber-style smartphone-based app. Uber matches people who want rides with people who are willing to give them rides. Well, this app matches containers that come off a ship with trucks who are willing to take such a container somewhere. So if you imagine a dock filled with different kinds of containers from different companies, and you have a bunch of trucks, but each of them is participating in the Cargomatic app, then the nearest container to the truck can be placed onto the truck, whereupon the truck driver finds out where it's going and gets paid all through the same app very efficiently. Well, that impresses me as an incredibly good idea. And there's no doubt that such an efficiency will affect in a significant way that very transition from ship to truck going forward as the dock strike fades into memory. Let me bring up another example of innovation. Tilapia. Everybody eats tilapia. Sometimes it seems like it's the only fish that's around. There are other uses for tilapia besides nutrition. In an article entitled Tilapia, a Fish That Will Heal Your Wounds, published in the Real Clear Science Journal Club on February 17, 2015, Alex Berezov describes how tilapia collagen can be used to heal wounds. So collagen is a protein found in the connective tissue of, I suppose, all vertebrates, maybe others too. It's produced by cells called fibroblasts. Say that 10 times in a row. And collagen facilitates wound healing. Now, we've taken our collagen from cows and pigs in the past, but the chances of disease transmission are somewhat high, or higher than people really want. And researchers from Shanghai discovered that tilapia collagen does not appear to provoke an immune response. Furthermore, tilapia collagen encourages the growth of fibroblasts and increases the expression of genes involved in wound healing. The experiment done in Shanghai compared tilapia collagen to algae-based wound dressing and found the tilapia collagen to be superior. Now, there is a soybean-based protein that promotes wound healing that's produced by a startup called Equalix, EQALIX, which is facing FDA approval. Presumably, somebody has or will create a startup involving tilapia as a source of collagen, and it too will go through the FDA drill. My point is, this great idea that arose in response to the exigencies of the West Coast port strike and the properties of tilapia collagen, assuming this was borne out experimentally through other tests, both look like sure winners. I mean, just sitting here. At any rate, people are incentivized in the United States to create a startup with such a sure winner and to grow that startup and maybe turn that startup into a mature company that's very large and very beneficial and makes a great deal of money. All of that takes place within the context we have here in the United States, which is a regime of secure property rights and unmonopolized financial markets and very large customer base. It's not like that everywhere. We know that many countries do not have, for example, secure property rights. But even a country that does, such as Israel, may lack some of the other qualities that make the U.S. such an attractive place to grow businesses. The Schumpeter nom de plume in The Economist magazine, dated December 13, 2014, in an article called Scale Up Nation, talks about Israel and notes that Israel has the world's highest concentration of high-tech startups per capita. So there's a lot of innovation, a lot of tech innovation going on in Israel. The puzzle is, why is it that so few of Israeli startups turn into big companies? That is, the startup starts up and somebody buys it. Some other big company buys it, rather than the startup itself growing into a big company. Well, the solution to that puzzle, according to the article, is that Israel has one of the world's most concentrated corporate sectors. 24 major conglomerates control nearly a quarter of the country's 596 listed companies and more than two-thirds of the total market capitalization of those firms. And these are principally family-based conglomerates. And by the way, that quality is shared by Israel with its Arab neighbors. These tend to be economies which are commercially and financially dominated by a few families which are approved of by the regime. Well, how did this happen in Israel? Well, part of its history, part of it is politics. Politically, of course, Israel was much more socialist-oriented in its origins and in its first several decades than it is now. So in a socialist economy, you have central direction from the government, and that led to the creation of large state-owned industries. Meanwhile, like its Arab neighbors, Israel had pioneering business families which were into all kinds of different businesses and which transacted with one another and created an oligarchic kind of situation in those areas that weren't dominated by the government. Well, in the 1990s, as the socialist structures were driven away by government policy, the government privatized many of the state-owned companies. So who benefited from the government privatizing state-owned companies? Well, those very same families. So that is why Israel ended up with 24 large conglomerates dominating the commercial and therefore the financial parts of the economy. You could imagine that large companies do not like competitors. Large companies who dominate the financial sector would tend to make the terms of capital harder on growing companies. So this problem has been recognized, and what politics has created, politics is undoing. In 2013, the Israeli Knesset passed the Business Concentration Act. To promote competition, it limits the use of pyramid structures and prohibits cross-holdings between financial and other firms. Now, the odd thing about this act is that it was passed unanimously. It would be difficult to imagine something passing the United States Congress unanimously, especially a business restructuring act. But this passed the Israeli Knesset unanimously, even though the Knesset has far more parties than the U.S. Congress, and its ideological dispersion is far broader, even though there are religious parties that are far more religious than religious American politicians, and secular parties that are far more devotedly secular than American secular politicians. However, the Knesset did see a problem, and it did act. So, with the Israelis recognizing a problem with their economy, we are given the opportunity to recognize those things which we take for granted in our economy, which after all draws in innovators and inventors from around the world. For example, Rana El-Khayyoubi of Egypt, who we talked about a few weeks ago as the founder of Affectiva, a facial recognition software startup. Well, with vigorous capitalism on the mind, let us turn to the interview with Mr. Drake. David Drake is a leading equity expert based in New York City. He is founder and chairman of LDJ Capital, a private equity advisory firm, and also of the Soho Loft, an event-driven global financial media company. The Soho Loft produces and sponsors over 150 events globally each year. For example, in April 2013, there was an event sponsored by the Soho Loft with speakers from NASDAQ, NYSE, KKR, and the Carlyle Group. Those are the kinds of events we're talking about. Mr. Drake is also an international speaker and writes weekly for Forbes magazine and the Huffington Post. He has co-authored the book Planet Entrepreneur, the World Entrepreneurship Forum's Guide to Business Success Around the World, and also the book Crowdfund Economics. We are privileged to have Mr. Drake on for the third time so far. He's spoken before about family offices, and he also spoke about online syndication of real property investment. And in each case, he was able to bring an international dimension to his remarks. And it is that international dimension which we brought to bear today, because today we're going to talk about angels in the U.S. and then angels beyond the outfield, that is, angels outside the U.S., angel investment. But I'm not going to start asking questions until I make one observation, and that is historically the term angel, as we use it, was originated in the late 70s and early 80s. But before that, angels were known on Broadway because the word was used to describe wealthy individuals who provided money for theatrical productions, so that the producer, the producer by Mel Brooks, the angels turned out to be dupes. But generally, angels usually end up risking a lot of money and either making a lot or not making a lot. But anyway, let's get to where angels fear not to tread, or how startups and angels find each other. David, your perspective.
Well, we've seen angel networks and angel businesses expand globally after the great financial crisis, mainly because something has to give to supply capital for startups and companies. And, the definition of angels, as you said, today is, individuals who have discretionary income to spend on, the excitement of most likely living vicariously through a startup, to be able to go through the motions, the innovation, and the startup mode of a company with entrepreneurs without having to commit their own time. But enough time of their expertise to be involved, engaged, be on the board, be advisors, and guide from their own experiences. And also way, I'm not considering myself an angel investor because I'm on the board for 4 angel investor groups, and I'm involved with both the association in the U.S. and in Europe, and I write for both of them, and I cover the news. That, we're doing it because it's exciting. We have discretionary income, and a lot of these angels are executives in their 50s, 60s. They're the kids left the nest. The kids left the nest, they have discretionary income, and they want to get excited, but they don't want to put all their eggs in one basket. So, helping a startup to get off the ground with their own experience, to do the small things and foresee what they need to do, is what angels have been supplying. But you're right, angels are not always motivated by money. They're motivated by the culture, the social good, the impact, helping others, supporting, educating. sharing their knowledge, passing it on. And of course, they want to have a return, but, some of these investments, it's taking 7 to 12 years to get an exit. And that's almost only 1 out of 20. But that's sometimes enough for you to make back all your money plus some profit. And we can go into details between countries and even regions of the U.S. where angels behave differently.
So yes, so they're getting new kids or new emotional attachments, new excitements. But before we get to whether individual angels are, differently, you can characterize them differently in different places, I'd also like to explore another term you used, which was angel networks, which isn't exactly the same thing, but it derives from the experiences of angels. So how are angel networks different from angels?
Well, the network is a network of angel groups together, working together and syndicating deals. And the angels are the members of the network.
Already, it seems that where we've lost the personal excitement and emotional connection, and we're really looking at investment opportunities. Is that fair to say?
Oh, for the angel networks, yes. At the angel network level, they might be excited about 1 out of 20 deals internally, and it might be too big of a deal. Or from the crisis, people want to diversify their risk and say, hey, we think this is the best deal out of 50. We're putting money in, but we don't have enough money. Or we have enough money, but we want to diversify risk because this way everybody's putting in a little bit more money. So it's easier to raise larger amounts of money. That's what we've been able to do with angel networks. And then you have the associations that makes all the angel groups and networks members of.
Okay, wonderful. So when we get back to the individual angels, I wonder if you could comment on, obviously there'll be angels who already knew, it's your son's friend starts a business and you kind of want to get into it as an angel. Well, there's that example. There must be other ways that individual angels get to meet the subjects of their interest. And how does that process differ between the U.S. and, say, the U.K. or Western Europe or other places?
Before I answer that, I want to make the distinction here that angel networks are looking to accredited investors for recruitment because they have set up policies and structures and processes that the associations are sharing with all the angel members in network on both continents. And they also cross-pollinate that information. And they help each other to do the best due diligence, the best contracting, the best review, the best voting process. And now it's getting more and more advanced on the best structures for these groups, on how they're going to invest. Because historically, over the years, they see what's more effective and less effective. So I'm seeing more and more, both specifically in the UK, where Angels Den is an angel network that has about 8,000 angels all over the world, implemented last October 2013. I was actually at Parliament in London speaking about crowdfunding. And what they did was they implemented crowdfunding into angel structure, not only to recruit and train new angels to join them from accredited investors, but also to diversify their risk and find more investors that will tag along. So in essence, their structure was, we're going to invest in this deal. So you, as an accredited investor who hasn't done the due diligence of an angel before and don't understand all the processes, or not as professional as we are in this process for a startup where the likelihood of failure is much higher, we're going to put our own money in, maybe say 20%, and you can tag along on this ride, trusting that we know what we're doing. Mm-hmm. And that's one way that they're starting to recruit more and more angels to the network. And I think that's going to be a trend that's going to continue for years because, investing in Kickstarter or in a startup, that's easy. Knowing what you're doing the due diligence, and managing those expectations with the startup, extremely difficult. And, I have a couple of banker friends who are now angels in Ohio, and we were talking in Dublin at a conference, and he said, you know what, as a banker, when I did my estimates and I did my calculations, you had the variance. But when I started dealing with startups, the first couple of years, that variance made no sense. When I realized it wasn't a variance anymore, but it was actually pure luck. The chance that something goes wrong and they have to close the office is extremely high because it's such early stage.
Yes.
And when he said, when I started calculating that being a probability or a chance, then it was a lot easier to analyze these companies. So that was very interesting to hear how he kind of looked at it and said he couldn't wrap his hands around it because there was too many unknowns. I probably have 30 angel investments myself, and most of them have failed. But some of them have made some good money for me, actually some incredible money.
So in David Drake's experience, just as one example, if you've had 30 and you've made money on a few, have you made money overall?
Oh, absolutely. One out of those 30, made millions.
And that perhaps is what might attract an accredited investor once the accredited investor finds out that his or her new friends have invested in 400 deals and have really hit it in 20 or 30 of those deals and have a positive record overall. And the accredited investor has an appetite for risk with this money anyway at his or her stage in life. Right. It's not like investing in a venture capital fund where you really do expect a certain return year upon year upon year, and it better be, over 15% or something, or heads will roll.
And let me give an anecdote here with the venture capitalist.
Yes.
The angel community has always felt that they get screwed by the venture capitalist. And over the last couple of years, venture capitalist is the really professional investor who's doing later stage investments because it's easier for them maybe, and they're more professional in their due diligence and understanding what works in their niche. And the reason angel industry never has had a problem with the venture capital industry is because venture capital historically had more money to invest, and the risk an angel takes early on gets diluted compared to the reward the venture capitalist gets and the dilution the angels get. I'll give you an example I'm referring to. Let's say you have a startup and an angel group decides that we're going to give you $500,000 investment from our angel group as a convertible note, meaning that we don't know what the value of the company is and we can't agree on it. So we're going to make a limit on high and low what the value could be. So we're giving a note now that could be convertible if we choose to. And we'll choose at the end of this note, maybe a year, maybe two, on that note.
Mm-hmm.
The problem that occurs with venture capitalists is that as these weren't done with enough knowledge by angel groups, the venture capitalists, so the angels are not putting in $500,000, risking, that the company might fail. And then the valuation, when they decide later on, might become $15 million. Suddenly their $500,000, let's say $10 million, $500,000 is worth 5%. And they started thinking, well, wait a minute. We put in 97% of the risk capital, and now we get diluted by venture capitalists because they're putting in high valuation and more money, and we only have 5%. So that's historically when angel groups started having problems with venture capitalists. They get diluted. They get screwed. So honestly, I've had angels, in 2010, 11 that told me, oh, great, the crowdfunders. Let's give it to them like the venture capitalists give it to us. Oh. Maybe they were facetious, but they certainly had that sentiment of, hey, we didn't know what we were doing because the driving force were not returns. Yet there are angels that want returns. I'll give you an example. There's an angel friend of mine in New York. He retired from, I don't remember which firm, something like IBM or Microsoft 30 years ago. He has 40, 50 angel investments, and his life is to walk Manhattan from office to office to office and meet his CEOs of his startups. He refuses to invest in an industry he knows, and it's considered super angel. Puts in maybe $50,000, $100,000. But he made it his life passion to just do this. He likes the energy. He likes, and he wants young people. Although most startups are, most crowdfunding campaigns as a startup, let's say, at age 44, 43. It's not in the 20s.
Yeah.
But a lot of angels have some idiosyncrasies, myself included. Initially, I would just invest because somebody else invested. I wouldn't do the due diligence. I would just trust them, and I want to hang out with my buddy. And average investments by business angels today in the U.S. are around $20,000 to $30,000 per person. But as a group, the average is higher, somewhere between $400,000 to $600,000. And if they're syndicated, it gets higher. In Europe, I think there is syndication between angel groups to help one company up to $1.1 million. Some of that has to do with the great financial crisis. And, hunger, there's more angels. I don't know if I told you, but European Angel Network went from $4 to $8 billion in angel investments in the last 3 years.
Okay, wait, let me stop you right there. Why has it doubled in the last 3 years?
Well, only in Europe.
Yeah, but just thinking about Europe, all we hear about in Europe is stagnation or disaster. Although England might be a bit of an exception these days, but only in a minor way. So how is it that angel investing has doubled? Is that because of a dearth of other ways to make serious money?
Correct. That's one reason. The other reason also, I was a U.S. Commerce Department representative in 2012 to Rome and Brussels on capital creation and small, medium-sized enterprise capital access. And there was a dialogue between the U.S. and Europe on best practices. And what should Europe do that works in the U.S., like small business investment companies and small investment funds, SBICs, and other programs. And part of the results were that the European Investment Fund are matching Angel Group's investments in Europe. You know, that's one part that came out of it. Furthermore, more and more people have to turn to other alternatives to raise money, and there's more and more organization of the angel networks to grow because they also have less competition. So the European Business Angel Network has made a manifesto as of this year to try to reach $17 billion by 2017, which means they're going from $4 billion to $17 billion in 8 years. And, you know, and the U.S. will probably be around $30 billion by then, but it's $24.8 billion as of last year.
Oh, that's a substantial amount.
By the way, there were 8.6 million accredited investors last year, correct?
Yes, that's about right.
750,000 of them were angels to put in $24.8 billion from the U.S. So that means, you know, accredited investors listening here, the changes in the law of the Jobs Act are allowing companies and angels and others to reach out to the accredited investors in a different way through advertising. So, you know, we're seeing a lot of changes, and it's happening really quick in the U.S., which I really enjoy.
So what you imply is that if the opportunity to engage in angel funding is larger than the current amount of angel funding activity in the U.S., or if that opportunity grows, there is an ample supply of accredited investors from whom such investment might come in new angel networks, for example.
Yes, but I got to remember, you know, matching funds from the European Investment Fund, that's a big deal because, you know, you put together $300,000-$400,000 and then you get matching funds. And we're seeing, you know, the size of the deals of syndication in Europe growing too. And I'm just excited because, you know, besides the U.S., there really weren't any other, you know, angel growth anywhere else in the world. Even in South America, we've seen growth, but of course it's tiny compared to everywhere else. But still, because of the difficulty, more and more people are finding each other. But also, the internet are allowing people to find information, read stories, and educate faster.
Well, that and talking with you, because I think I'm tempted to talk offline with you about a European film I'm trying to get produced, and the potential for angel injection of funds to help make that happen in Europe.
Gladly.
Okay, good. It is said that angel-funded startup companies in the U.S. have historically been less likely to fail than companies that rely on other forms of initial financing. Assuming that's true, and maybe you can opine as to whether it is, but assuming it is true, is that mostly a function of the amount of capital being brought to bear, that it's, i.e., it's sufficient compared to other forms of financing, or is it something about the angels?
It's about the angels, and I'll give you a couple of comparisons. The New York Angel Group, as well as the Funding Post Angels and Archangels in New York, they're finding out that if 4 of their members or more both do the due diligence and want to invest in a deal, it has a higher success rate of exiting at a higher level and quicker. Furthermore, angels are actively involved with the startup and make sure they meet them and talk to them at least once a month, have a you know, almost 10 to 50% higher rate of exit and return because they're giving guidance. And what happens with startups is they don't know what they don't know.
That's exactly right. And it's not just guidance, it's also calling them to account every month.
Right. And it's a balance of everything. I mean, just the marketing department of any company that's growing is going to have 200-300 projects lined up waiting. You know, it just, you know, that's just one little aspect of running a business. And then you got to stay firm and flexible enough to stay on course. But then if money's coming in from a different strategy that you didn't expect, you got to be flexible enough to say, well, hold on a second, what's going on? I mean, there's so many things to running a business. And the angels allows, you know, a professional way to approach it because, you know, these are professional business executives most of the time who has actually worked in this space and in this arena before. Of course, some angels just want to work in arenas they don't know because they want to learn.
Yeah.
They want to learn about new things, and I get that. It's exciting. I don't want to talk about shoes if I spent 20 years in shoes. Well, some people say, I don't only want to talk about shoes because I did spend 20 years in shoes. So it all depends.
So if you're making these decisions early on, and you might even have access to bank financing, well, bank financing might present a tax advantage on your bottom line at a certain point. However, you're not really I don't
see banks without asset-backed.
But even when you do a loan with a bank, what do? They cause you to fill out a financial statement every year. I mean, it's very, very passive.
Before the crisis, even then, they wanted to see existing revenue, so they can actually base it on the revenue, length of operations for a few years, and also they want to review which industry you're in. So after 2001 and the dot-com boom, one investment I had was in real estate, but the company was called .com. I got denied. The investment got denied financing because they didn't care it was real estate. It said .com. And that was before the great financial crisis. That was 2001.
Wrong kind of language to use in front of a lender, but maybe we shouldn't even speak of lenders.
I didn't have a choice. That was an incorporated name.
Okay.
But banks are not lending for startups. There has to be angels out there to put in $10,000, $20,000 and then help them.
So isn't the sequence usually seed money from friends and so forth to get started, then angels filling the gap, and then, of course, the venture capitalists to come and suck up all the equity and dilute the angels? Isn't that the usual sequence?
That has been the usual one, but now you have crowdfunding, and you have other financial tools and solutions out there that make things around inventory financing, credit card transaction. There's even a company who will lend you money based on the amount of activity on key components of your business. Not necessarily how much money is coming in, but how much traffic, incoming leads, emails, hits on the website, and algorithm, which is interesting because Thomson Reuters family office, I think, was involved with that, and we've been working with them for years. We work a lot with family offices all over the world. Well-known ones like Maybach from Mercedes-Benz and Thomson Reuters and the DuPont and Rockefeller on an ongoing basis. But yes, that has been the natural progress. Now you have crowdfunding in the middle, and that ecosystem is balancing out, where friends and family and crowdfunding can work hand in hand. How crowdfunding may or may not work with angel networks. Right now in the U.S. it's not. In the UK it is with Angels Den and another group. They're leveraging that. But it's going to take time for this ecosystem to become more clarified.
Okay.
And I'm part here with you to discuss the ecosystem of different finance situations.
Let's go right to ecosystem there, because one aspect of the ecosystem is legal. We were talking earlier about how venture capital funds can swoop in and dilute the angel investor. Well, it strikes me that the angel investor might be able to get the company, the startup, to agree to certain legal protections for the equity position. And if that's the case, well, there might be a court fight later, but at least you're before courts that function here in the U.S. or in the U.K. So one wonders if angel investing, which seems to be reliant upon a effective and fair legal system, whether angel investing is seen in important levels in places like Russia or India or China.
Well, the European Business Angel Network did have an annual event last year in Moscow, so there is an angel network group out there. We've seen the Baltic states and Eastern Europe doubling in size over the last 2 years, which is a pleasant surprise. While in China, the concept of business angels is not well known. And the Thai as well, they're not familiar with the concept of a business angel. Like you said, a business angel started from theater in the U.S. In the 70s.
But they have theater.
Yes, they do. But, it's tied to the patriarch who invests in it, and they don't have the word business angels per se.
Yes.
The same thing with family office in China. You say family office, and they don't understand the concept. The organization, by hiring your own in-house staff to run everything for you, they have that through the family network, but it's not organized as well and professional as it is in the West. So that's another opportunity that we are exploring more and more.
So among the things that might be hampering development in these countries is the lack of a viable ecosystem for angels, in addition to a lack of familiarity.
Yeah, and that was the issue with Europe 3-4 years ago as I kept trying to Europe. There were startups in Europe, and they just had no infrastructure or organizations to advise them on best practices. So the associations of angel networks in the U.S. and Europe are great because you get together and you talk about best practices. How do you do the due diligence best? How do you do pro forma best? How do you avoid getting diluted from a potential VC in the future?
Yeah.
And, Silicon Valley, for instance, they'll do convertible notes all day long because they're competing for the business. Mm-hmm. While in New York, New Yorkers got burnt by convertible notes from VCs, so they hate it. They don't like it, and they don't like being diluted from that. So some of the solutions that come up over the year is, you can do convertible notes still and not get screwed as long as you set limits, and bottom limit and the maximum limit. So if I give you $500,000 now, you can't dilute me above $5 million, and limits it. That's one scenario that we've discussed over at the different angel association. But that professional network are sharing best practices, and they're very willing among different groups and associations to give you all the documentation, all the paperwork, and everything you need. So it's part of the culture of, hey, we want to educate the startups and help them, but we'll also do it with each other.
Well, let me close with your thoughts, with soliciting your thoughts on the following, because I think you've already answered it, but I'd still like you to talk about it a little more. One, sitting here in 2014 surmises that angel activity was at one point heavily concentrated on Silicon Valley as the birthplace of so many technology companies. And then one surmises that angel investing became more common, again, leaving aside the theater example, more common otherwise in the U.S. Has it spread everywhere and into all kinds of startups? Is there anywhere in the country that's underserved by angel investors?
Well, underserved in the U.S., I think the U.S. is the most advanced angel investor network in the world by amount of the angel investors from the U.S. alone stand for more than 50% of all angel investments in the world. So you're just going to have to go with metropolitan areas versus urban areas, which goes without saying. It was a little frustrating 3-4 years ago being in Europe and seeing that companies just had nowhere to turn. But that became an opportunity, and they have done a good job accelerating that opportunity the last 4 or 5 years. I'm very impressed how quickly it's grown. And that's just from one angel network, which is the European Business Angel Network. You have the competing angel network called the Business Angel Association of Europe. And that's an offshoot of last year, I believe, 400 or 500 other angels. So it's fascinating to see these things happening over there and being able to cover it, educate, learn, at the same time educate people over here and vice versa.
Well, okay, but then I can't resist asking one more question. When one reads, for example, the Wall Street Journal as the America's leading daily financial paper, one sees story after story in Europe about European banks. One might also see that in The Economist. Banks, banks, banks.
Absolutely.
So because they're easy to report about, because they're very public and you know where they are and there's numbers, and it's easy for a reporter to put stuff together for a story that can go into the newspaper, and it's all so important. And obviously the banks are under a great deal of stress in Europe, but you're telling a story where capital needs are being met by other means, by angels in particular. And so maybe the advice then for a person who might be needing capital is to pay attention to what's not in those newspapers or what's hidden in those newspapers. Well,
you have to discern what it really means. I mean, historically, we believe that you have a startup. Well, historically, the world believes you have a startup, and the first thing to do to get money for your startup is go to who you trust with your money, which is your bank, who has money. And traditionally, that's what everybody does. They go to the bank and they get a no. And obviously in the U.S., people are more well-informed to realize that that doesn't fly at all, as well as in Europe. And with the banks, they're sitting on corporate debt that they need to get off their books. And we're talking about billions per bank. They certainly don't care about dealing with a $20,000 to $100,000 loan for a startup with no assets behind it. Mm-hmm. They have so much overhead and trouble to deal with that they don't even want to touch it. And they're like, why should we even touch it? We're sitting here with a problem. And this is what happens in most industries, or all industries, at each crisis we have. The Russian default in 97, 98. The same thing happened, as well as the .com. So, one day, a startup is worth millions, and then within a couple of weeks during the crisis of 2001, poof, worth nothing. The banks got to get long-term debt, corporate infrastructure debt off their books, and short-term, because the banks traditionally lent 30% of corporate debt in Europe, while in the U.S., banks only lend 5 to 10%, while accredited investors lend between 20 to 30%. Accredited investors in the U.S. are the most sophisticated private investors in PPMs and private offerings. So a lot of brands from Europe over the last few years have been doing offerings in Europe and the U.S. because they have brand recognition, and accredited investors are more sophisticated in understanding. They're accustomed to see PPM. They're used to understanding that the law requires you to have a document and due diligence and compliance. And there's more comfort in that process. So we've seen companies in Europe, raise their money in the U.S. because the banks are getting rid of the debt. And because of that problem, they do not care about startups. If you're going under, the least thing you have to deal with is to start a new division to deal with $20,000 loans.
Right.
When you're trying to get a headache off your lap that is in the billions.
Okay, so that's one set of problems that the press cares about, when there's a whole set of opportunity that's not being reported. But accredited investors and this sort of information can be brought together, including by programs like this and publications like Accredited Investor Markets, which I'm making a plug for, which provides a newsletter every week on such topics. Well, Mr. Drake, it's been a pleasure.
A couple parting words. I write for Huffington Post and Forbes, and I do so on a weekly basis. So I would encourage people to find articles on the David Drake, if you Google it, and read more about these things on the educational process of accredited, venture capital, crowdfunding, and business angels.
Oh, and don't forget to check out the website for the Soho Loft. If you just look for those 3 words, you'll find still more information provided by Mr. Drake and his colleagues, but also perhaps opportunities to meet.
And we're going to give away a chapter of my new book for people coming to the SohoLoft.com.
All right. Well, thank you, Mr. Drake, and thank you, everybody listening to this episode of Accredited Investor Markets Radio. I am your host, Christopher Cahill. This program was produced by Stephanie Strait. Let's do this again sometime soon.
Thank you for joining us. If you enjoyed this episode, you can subscribe through iTunes or Stitcher, or you can download our app from Libsyn. You can also listen right on our website, www.AIMkts.com. Each week, Accredited Investor Markets Radio brings you news and education about investing with a focus on alternative assets. To see a short written summary of this episode, go to www.AIMkts.com. Accredited Investor Markets Radio is a production of Financial Poise Radio Productions, LLC.